Welcome everyone. I'm going to talk about income, and which wouldn't be a surprise. And I'm going to start with a market update because it has been a very interesting market. If we go back to 12 months ago, who would have thought interest rates would be below 1%? Who would have thought we'd have a dividend bonanza in the last financial year, more dividends than we've seen ever, and a record sort of income coming out of both PL8 and the underlying investments. So just in history, FY19, why did we call it the dividend bonanza? I think it's a term that Peter Gardner, who works in portfolio with me, he's at the back up there, senior portfolio manager, termed dividend bonanza in 2019. We saw massive dividends from the Rios, the BHPs, the Fortescues. We saw special dividends. We saw buybacks from BHP, Rio, Woolworths, Caltex. Big increases in dividends for many resource companies. But as the subtitle goes, we saw income, but not from the usual places, because normally you'd think, banks and Telstra, they're the big income producers, but it was actually out of resources in many respects. Also, a few companies selling things, so Woolworths returning capital and Wesfarmers paying a big special. Woodside did as well, and a number of companies were fearful about the implications of the ALP franking policy, and we saw quite a large number of, companies flushing out those fully franked dividends before the end of the year. And in fact, my fellow directors were at PL8. We also decided that we would reward shareholders and pay a 3-cent special dividend out of the bounty of dividends we got from the underlying ones in case the ALP changed the rules. As we now know, those rules haven't been changed when we did actively campaign on behalf of our many investors to educate the market, educate the politicians, educate investors and advisors about what we thought was a fairly unfair and discriminatory policy, because some investors would still get their franking. I'd still get my franking. High tax investors still be able to use it, but someone like my mother, who was didn't get a pension, she had too much money for that, but not much more than the assets test, she would have lost all her franking, yet she wasn't a very rich person. So we thought it was very discriminatory in the way that was enacted, and I think that has been put to bed for quite a while. So we're glad to see that. And as I said, we did pay a 3-cent special, but what I would say is now that the franking's all over and done with, we do not expect that extra fillip on dividends this year. We don't think we will see an extraordinary level of dividends. So we think the dividend bonanza is over, but dividends themselves are still quite strong, as we'll talk about even the latest reporting season. As I said, who would have thought the cash rates would now, a year ago, if you'd said cash rates are at 75 basis points and potentially going lower, the market is factoring in another 25 basis point cut to 0.5%, and 10-year Commonwealth bonds have traded below 1%. They've actually traded below 90 basis points. They've traded below 0.9%. So you invest your money in a Commonwealth bond and you would get a less than 1% per annum income for 10 years. That is unbelievable. And I think it's a reason to invest in PL8 because, we still see, and we are still paying 0.5 cent per month normal dividend on that company. We're still seeing good dividends from the underlying market, and our rotation strategy is still able to provide strong dividends, even in this somewhat soft environment. What I would say, my personal view is the RBA has gone hard and gone early because the government isn't going to isn't going to spend a lot of money, splash a lot of cash out there. That's what they've said. So the RBA is doing early lifting because they're trying to get the economy going. Personally, I don't think they should cut interest rates anymore, but I think it's pretty much gone as far as it can. But that's what they're doing, but they have indicated very, very clearly, there's a comment there from Governor Lowe, that interest rates will be low for a substantial period of time. So we don't expect things like term deposits to change. It also impacts things like bank income securities because a lot of those sort of cash-related things are tied to bank bills. You get a margin, you get bank bill plus 3%. Well, if bank bills are now trading at 1% or less than 1%, that means you're getting 4%, but at the start of the year you're getting 5%. So you've seen a 20% cut in your income in those sorts of things. So the low rates have spurred the market higher. I think that's why the market has been very strong calendar year to date, because a year ago, this time last year, we were all worried about US interest rates going up. Now we're worried about US interest rates going down and Australian interest rates going down. And it was a somewhat soft, this is looking to the August reporting season, it was a bit of a soft period, but I don't think it was anywhere near a recession, and to me it didn't really warrant 3 interest rate cuts. There were 2 before the reporting season and 1 in early October. There were some lowlights, the likes of AMP and Adelaide Brighton pre-announced poor results and pre-announced they're not going to pay a dividend. Happy to say we didn't own either of those 2 stocks. But overall, interestingly, when we look at the reporting season in August, it wasn't actually that bad. The average increase, and it was an increase in dividends, was 9%. So companies year on year that paid a dividend or announced a dividend in August this year compared to what they announced last year, the average dividend increased 9%. The median, which is maybe a better number because we had a 100% increase by one company, or actually a 300% increase, the median was still up 3%. So dividends are still going up even though your cash rates are going down. And overall, some quick stats, 53% of companies that we track increased dividends in the August reporting season, 23% maintained dividends, this is on a cash dividend basis, and 23% cut dividends. So you still had more than 2 companies increasing dividends for every one that was cutting dividends. And a cut can be to 0, so an AMP would be a cut. If a company initiates a dividend, we count that as an increase as well. And there's the numbers I've already talked about. 9% average increase in dividends, 3%. That is at a slowing pace though. If we actually look at what happened in February reporting season earlier this year, the median increase was about 5%. So it has slowed, but we have got that franking credit sort of tailwind has now gone away, and so companies didn't feel the need to flush out those franking. We still have the same highlights. So actually, this is Fortescue, Rio, and BHP. Even in this financial year, the one we've just entered, have increased their dividends substantially. And Rio paid a $1 billion special dividend. I mentioned that the 300% increase in dividends was Independence Group, so you probably want to discount that. It's a very small company and paid a low dividend, so that's why the median is probably a better measure than the average. One of the highlights, and you would say not much of a highlight, JB Hi-Fi increasing dividends by 11%. But if you think about all the commentary in the media, it's retailers are getting hammered, retailers are stuffed, Myer and blah, blah, blah. But actually, increasing dividends by 11%, lifting earnings, that's not a bad result in such a poor retail department. Another highlight was Qantas, and we have just participated in the $400 million buyback. So Qantas and a smaller company, Macmillan Shakespeare, announced buybacks during the reporting season. We love those because it's a great way of flushing out franking credits and cash dividends for our investors, our retirees. They get the value of that. I mentioned the lowlights before, the AMPs and the Adelaide Brighton Speedcast. We didn't own those guys, so they weren't an impact. But there were some other ones. Fellow colleagues talked about Blackmores, and Illumina and Caltex have cut their dividends as well. So there wasn't all positive. But I would remind the thing, it has, an echo of view of, probably Jacob will say this as well, and of Spheria guys, is it has been a tough market for your traditional income or value stocks. So we've actually done pretty well. But if you actually look at the big income stocks and you immediately think about banks and Telstra, I mean, they've underperformed for the last couple of years. This is actually a graph on the right-hand side of the performance of the banks and Telstra compared to PL8 since the listing of our company. And we actually own some of Telstra and some banks over that time, but we're not overweight the banks, but we do rotate actively through the banks. But banks as a whole have underperformed, and so PL8 has performed better than if you just owned the banks. And in fact, that was one of our, I suppose, reasons for PL8 is you can get a good, steady, high level of income out of a diversified portfolio of shares. The alternative may be just buy 1 or 2 banks, but clearly we've had a lot of risk and continued risk with Westpac cutting its dividend 15% this week and doing an issue. But the banks have been under pressure. Telstra is under pressure with the NBN. I'm happy to say that PL8 has outperformed those and still delivered on its high income strategy, even though they are typical income stocks. The other thing I want to do is just a long-term thing about the value of franking. We've gone back 15 years, because this is when the index started, looking at 3 indices. The S&P 200 price index, which is the dark blue line, which hasn't gone a long way in the last 15 years. It's only up 3.1% per annum. But don't forget the dividends. If you add in the cash dividends that have been paid by ASX 200 companies, actually it's 7.7%, so 4.6% higher. There's been about 4.6% cash dividend being paid by the index over the last 15 years. But if you add the franking, 9.3%. So suddenly 3% doesn't look too flash, but 9% actually is not a bad number, really. 9% total return over the last 15 years, especially if you compound it. When you add that up, actually, if you compound that 9%, you're actually up 251%, which is a lot more than the prices. So please don't forget the franking and the income, and particularly for PL8, which pays a high level of income that's fully franked. Getting back to our strategy, for those who've seen this before, you may have seen this, but we are an active trader. We actively buy stocks for income. We may only own them for a few months, we may own them a whole year, but if we're buying a stock purely for income, we'll buy it to capture the dividend, to capture the franking, and generally we find there's some outperformance around that period as well when they announce the results. And by doing this across the market, that is how our underlying investments can generate much more income than the market. And normally that's around 9% income after fees versus a market of 6%. But indeed last year it was a ridiculous number that was more like 15% in the underlying investments. So a real bonanza. But under that we analyse companies like all the other managers. We look at valuations, we look at quality and how businesses are going. We like iron ore miners because they're making a lot of money at the moment. We don't like AMP. But also at the last one there, we try, because we're focused on income and dividends, we love big dividends and big dividend yield stocks, we don't want to get sucked into the dividend traps. And one of the dividend traps for the last couple of years has been AMP. If you're an AMP shareholder, you probably don't need to know that, but AMP actually cut its dividend to nothing didn't pay a dividend in the last reporting season. And it might have seemed to some people, if you looked at the historic yield of AMP at the start of this year, you might have been able to purchase it around a 14% gross yield, including franking, except when it cut its dividend and now you're finding you're getting nothing. And by the way, the share price of AMP over the last 2 years is more than halved. If we had held AMP, we would have underperformed the market significantly, but we also would now be not getting any dividends for you. Thankful to say we haven't held AMP for over 18 months. So avoiding dividend traps is one of the keys to income investing, and there's quite a few dividend traps out there at the moment. I won't focus much on performance. Our performance has been pretty good. This is a longer term performance of the underlying investments, and in fact we're happy to say that we actually have one of the investors who was the first investor into the underlying fund that PL8 invests into is in the audience. He's so happy with his investment he's in PL8 as well, so congratulations George. So, but we have been able to outperform in what has been a difficult period in the last 12 months. It has been a tough period for value investing. It has been a tough period because income investing is value investing. We haven't owned those waxes either, and they've been the star performers. But by looking for income opportunities and buybacks and other things, we have been able to outperform the market. And particularly after tax, we had a ridiculous amount of franking last year due to all the buybacks and things. So, and I'm just going to show you this is the 12 months to the end of September. The Plato Australian Shares Income Fund is the underlying investment vehicle of PL8. PL8 owns units in that fund. And that fund has delivered a 10.8% cash yield to PL8, distributed that into PL8, PL owns that, and a 4.5% as a percentage franking credit yield. So that's a very high yield because of those buybacks and those special dividends and other things. That will come to an end. We'll go back to a 9-ish% gross yield, but we've, in the 12 months to end of September, it's over 15%. That is a dividend bonanza. But 9% is still not shabby. PL8 itself, including the special, has distributed most but not all of that income out. It has kept a bit back into kitty because we're saving it for a rainy day, but it's in the NTA. And the NTA, by the way, doesn't include 1.3 cents of franking credits, so that's not included in the NTA. But it's still about a 12% yield if you include the franking. If you just use, if you discount the special dividend, which is, probably won't pay a special this year because we haven't got the dividend bonanza, although directors will decide that, it's still a pretty good grossed up yield for the underlying fund and substantially more than the market. And there's the longer term investment performance that someone like George, who has been in that fund for the last 8 years, just ticked over 8 years, would have got. We've had consistent outperformance versus the index. We're not big swingers. We want to consistently outperform by a little bit and pay a good, solid dividend or distribute, the underlying fund does, but in PL8's case, repackage that into a consistent monthly dividend for our retiree investors largely to live off. And just about NTA, we've been lucky enough to be one of the LICs that is trading at a premium to NTA. but not for the whole year. In fact, for most of the financial year, if I can get this quicker to work here, when PL8 enlisted initially, it was trading at a premium and started to trade at a discount around here. Now that period here is March 2018, which is etched into my brain because that is when the ALP came out and announced the franking credit policy. And largely we traded at a discount until May 19 this year, which was the election when that franking credit proposal off. And since then we've traded at a premium. So that has affected sentiment, but I'm happy to say that we are trading at a premium to NTA. That's all I said in summary. Interest rates we expect to remain low for a considerable period of time. We're just reiterating what the RBA is telling us. The dividend bonanza is over, but we think dividends will still be strong this year, but not the 14 or 15% we saw last financial year. And for income investing, we think having a well-diversified portfolio and avoiding dividend traps is the key to consistent delivery of income. Thank you.